Hey, what's up, everybody? This is Sam Kwak here, one of the Kwak brothers, and in this video, we're going to go ahead and address the question, should I refinance my home right now in middle of the coronavirus epidemic? And welcome back, everybody. This is Sam Kwak here, one of the Kwak brothers, and this is a question that I get quite a bit right now, which is, Sam, should I go refinance my home during the coronavirus epidemic? And the real question that they're asking is, Sam, should I go refinance because the Federal Reserve rate is now at 0%? Well, there's some misconception around this topic that a lot of people believe that the interest rates are super low right now because the Federal Reserve has dropped the rate, which isn't entirely true. What's really happening is that because of this demand, that there's this perception that the interest rate's low, the banks have increased what's called a marginal rate. Now, the marginal rate is essentially the rate that the banks are charging you on top of the Federal Reserve rate. So the Federal Reserve rate is at 0. Most banks are right now charging anywhere between 3 to 5% in terms of the marginal rate. So consequently, the real interest rates that you'll end up paying when you refinance or get a new mortgage is anywhere around 3 to 5%, unless you fit in some sort of special category, such as the VA loan or FHA. There are some exceptions there, but majority of the banks are still charging relatively the same amount of interest rate as they did before this whole coronavirus epidemic. So that's myth number one. That's right now. There's a lot of misconception, and I know a lot of the realtor friends that I have are going around pitching that the interest rates are low, therefore they should go buy a house, which is not all that accurate. It's not all that true. Be sure to check the facts before you go out and refinance and get a new mortgage. Now, the second point that I want to make is that refinancing in general isn't necessarily best for your financial decision. And I know a lot of you might be saying, well, Sam, shouldn't I want to refinance to a lower interest rate? Isn't that the better idea? So what I'm going to do is I'm going to go and pull up a clip from one of my last YouTube videos explaining why refinancing is terrible. You're not actually saving money, even though the new rate is at a much lower rate. So I'm going to go and pull up the clip right now and have the old me explain why refinancing is terrible. A lot of people come and tell me, Sam, my mortgage broker, my banker says I can save money by refinancing. Is it true? Well, sort of. I'm going to share something that the bankers and the mortgage brokers are not telling you guys. So let's go and dive right in. What I'm about to draw for you guys is called the amortization chart. And trust me, I know this might sound boring. Stay with me here. I'm going to make it really fun. If you guys know me, I like to joke around and I like to have fun, including with topics like finance. So let's go in and draw up the chart. And this line that goes from left to right, this right here, represents the amount of years that you're going to spend paying off your mortgage. So a lot of you guys may have a 30-year amortized mortgage, meaning it takes 30 years to fully pay off your mortgage, or some of you guys may have 15-year amortization. I'm going to go in more so with the 30-year amortization because that's the vast majority of people today and their amortization schedule. So this is 30 years, okay, 0 years. And this line that goes up and down right here, as you guys can see, represents the monthly payment that you make to the bank for your mortgage. So I'm going to go in with a random number of, say, $1,000 a month. I know some of you guys may have more, some of you guys have less. Well, this is just an example. I'm going to draw a line that represents the amount of interest that you're paying over time. So this red line, I'm going to choose red. There we go. This red line represents the amount of interest that you're going to pay throughout your 30-year mortgage. The more you pay off your mortgage, actually, the less of an interest you pay. Blue line that I'm about to draw here for you guys represents the principal that you pay every month. So this represents principal. So principal is what we want to pay off more, right? Principal is the actual amount of the mortgage that we're looking to pay off and builds equity, builds wealth, and it's the good thing. Now, of course, interest is what goes to the bank. It makes the banks more money. It's profitable for the banks. So thus, we don't want to pay as much interest, and it's not in our best interest, right? It's kind of weird to say that. As you can see, if you just got your mortgage, right, vast majority of what you're paying in the beginning is towards the interest. So this right here area, right? That's all interest. So out of that $1,000 monthly payment that goes to the bank, approximately 80 to 90% of it is going straight to interest. And of course, it all depends on the interest rate that you may pay. Vast majority of it, guys, towards the beginning, banks are profiting a lot of money on your mortgage, right? Now, of course, the longer that you pay the mortgage, right, the longer that you stay on this mortgage, you can see that you're picking up more equity, you're picking up more principal, and you're paying less interest. Now, here's the issue when it comes to ultimately the refinancing. Let's say you make it to about 8 to 10 year mark. Let's say this is 8 to 10 years. When you get to this part right about yonder, as you're starting to pick up a little bit more equity, you're picking up more principal, starting to pay less interest towards a bank, well, guess what happens? Well, a couple things happen. Number one, a lot of people today internationally are moving quite a bit for a new job, a new career. Their kids are graduating, whatever the case might be. But if we're talking about just the United States, vast majority of us switch careers quite often now, right? We no longer have a culture where we stick around for 30 years and we retire and the company takes care of us. We don't have that as much as anymore back 30, 40 years ago. So today we're always switching jobs, right? From every 7 years, we're looking to get into a new job, new career. And that may mean we have to move. We have to sell our house and relocate to go to a different location. Well, what happens is if you sell your home and you decide to get a new mortgage, well, do you get to continue this progress of from the 8 to 10 year mark all the way to 30? No, you don't get to. Now, there is an option where you can actually buy a new home and get a shorter amortization, but most people don't do that because one being lack of cash flow or they just don't know. So when you get a new home and you enter into a new mortgage, well, guess what? You don't get to continue the progress from there and out. You have to start all over from the beginning, pretty much year zero, and you're back to paying this huge amount of interest all over again. It's not to our advantage to actually move and buy a new home and so on, because we're, again, going back to this area of paying more interest. So the technical term for that is called front-loaded interest, meaning towards the front of the mortgage, beginning of the mortgage, it's fully loaded with interest. Even if you don't move, right? Even if you don't relocate, if you stick around the same place for a while, well, this is when the mortgage brokers and lenders will start to contact you or call you and say, hey, Mr. or Mrs. Borrower, congratulations, you've been paying this mortgage for a fair amount of long time. 8 to 10 years is a good chunk of time. Listen, we got this amazing promotion. We got this amazing interest rate. Come on down to our office. Let's go and take a look at this again, and let's get you refinanced to a smaller amount of interest. And of course, most people are like, hey, that sounds like a good idea. Let's go and take that $1,000 a month of payment that we have. And this mortgage broker sitting in front of me is telling me that I can go from $1,000 a month, and if I refinance, I can go down to $900 a month. And most people, of course, unfortunately, they're not as versed into finance and financial literacy. They take a look at that. I'm like, oh my gosh, that's $100 that I can save every month. That means I can buy more groceries. I can go and put more gas in my car, or I can go spend this on Vegas, whatever the case might be. Most people fall into this trap thinking that, oh, I'm saving money, when they're not. It's kind of like going into a car dealership, and of course the car sales guys trying to get you focused on the monthly payment. They don't want you to pay attention to the price. They don't want you to pay attention to the interest rate. All they want you to focus on is the monthly payment, because that's how most people think. They think short terms. Well, of course, you guys are pretty smart to figure this out by now. Yeah, you're paying $900, but guess what? You're going all the way back to the beginning. You're not getting to continue that progress of from the 8 to 10 year mark. You have to go back to year zero, and again, you have to pay the full, the front-loaded interest, all that interest back to the banks again. So the banks are in it for the long term. They're not in it for the short term. They don't care that you're going to be paying less, as far as $100 every month. They really don't care. What they do care about is how much you're going to actually end up paying by the time you get to the 30-year mark or never. Because what tends to happen is people keep on refinancing over and over. So this is what happens. They get to the 8 to 10 year mark and they refinance again, right? They go back and then they get to this part and they refinance again. So pretty much a lot of people perpetually get stuck in this realm of paying crap ton of interest. And excuse my French, right? I mean, that's a lot of interest that you're forking over. So most people never get to this zone here, pretty much after the 10 to 15 year mark, where you're actually getting to pay off mortgage, you're paying your principal, you're actually getting to pick up your equity, your net worth. This is the spot that you want to be in, right? To pay off the principal. Now, okay, so I hope that gave you some explanation as to why refinancing is not the best idea in general, especially now these days. If you're going to go and pay off your mortgage or look to save money on your mortgage, be sure to check out our other video, how to pay off your mortgage within 5 to 7 years. It's going to explain exactly how you can do so without having to refinance into another 30-year or 15-year mortgage. I hope that video is going to explain everything about that. So just a recap of what we talked about today. I know the perception right now is that the Federal Reserve has dropped the interest rates but it's not necessarily translating to the actual interest rates that you may pay during a refinance or a new home purchase. So be sure you keep that in mind before you go shop around, and don't let a mortgage broker convince you otherwise. So thank you so much for tuning in. Be sure to subscribe to our YouTube channel for more updates right now about the coronavirus and its impact on real estate, finance, HELOCs, etc. Join us. We're actually having a live session again pretty soon here for Q&A. So be sure to subscribe to our YouTube channel. Hit the bell notification icon so that you get notified. All right, appreciate it. Love you guys, and I'll see you guys in another video. Take care.